Excellent. Okay. Refinancing your mortgage, right? Pros and cons, of course, to looking at this. Now, you guys would have seen some of my advertising probably online where I'm talking about, like refinancing can be one of the worst things you do, because if you don't have context behind how to do it, how to set it up properly, if you're just chasing an interest rate, um, and kind of maybe a cash contribution without really getting the understanding as to how would you do the refinance to make sure it's working for your benefit, it can work not so good, right? Like from the perspective of you can put yourself in a worse position because you've just set the reset button and so forth. Now, you guys aren't going to do that, of course, because I'm coaching you and guiding you here. But what I want to drill down on tonight is, okay, how can you use refinancing to your advantage? What type of things can you do a bit differently? And so, what is mortgage refinancing? Well, most of you are going to understand, pretty basic type stuff, is that mortgage refinancing is the process of replacing your current home loan or investment debt or whatever it might be, but we'll just stick to the owner-occupied stuff at this stage, with a new one, right? So typically to get a better interest rate, lower monthly payments, or access equity in your home, amongst a few other things you can sort of do. But those are the main things that people would concentrate on. Sometimes you would be doing it on the basis of, moving from a second tier lender, getting into the position where you can get back to a bank. That's great because obviously it's cheaper interest rates and so forth. So you'd want to be getting into there as quickly as you possibly can. Reasons to refinance. What does it look like? Well, as I said, so lower interest rates. If the market rates drop, then refinancing can reduce your interest costs. So, a lot of you guys are at that sort of stage at the moment where it's coming up to a fixed rate sort of review. You might have been with your bank for, I don't know, 3 years in place. You've had your lending there for a little while. So it potentially does make sense to have a look what's out there in the market, right? From the perspective of going, like, especially what's an example we could use? If you're with one of the banks that don't have the optimal type of revolving type facility, where it's maybe a reducing limit or you're having to reapply for it every few years, well, this could be an opportunity, obviously through refinancing, to kind of get that set up properly, but take advantage of a few other things that come through as well. So you could, lower your monthly payments. So that's talking about extending loan terms or getting a lower rate can reduce your monthly mortgage burden. Okay, so let's just be clear here for everyone. What we do not recommend this in Kiwi Money School is to go and extend your loan terms, because at the end of the day, if you're going to refinance and go to another bank, it really should be a year for year type thing, right? From the perspective of, if you've got 26 years to go and you want to refinance, that's cool, all right, get a better interest rate and so forth, or the right product, as I mentioned. But what we do not want to do is go, oh, great, we've got a cheaper interest rate, let's go to the next bank. And if they allow you to, is extend that term back out again. Because remember the stuff we talk about in the webinar, it's like hit the reset button, it's kind of all front end loaded with interest and so forth. And so that's where people get caught in that trap around going, oh, maybe we should take that cheaper interest rate. Whilst we're at it, let's extend the loan term because we're in that minimum payment type stuff, which, as we know, costs an absolute fortune. But I just put it out there. That's what some people would do as far as refinancing is concerned. But it's a little bit of a trap, especially around the loan term stuff. However, there is the odd occasion where sometimes it does make sense. I'm just going to put it out there. I'm contradicting myself, but I just let you guys know as to why. So sometimes if you're maybe needing to extend some terms to make the application work to buy an investment property, that's something sometimes you can kind of consider in the space of things. But that's why it's really crucial to make sure you've got this, what's the word for it, reduction kind of strategy moving forward as well, right? So you can understand that sometimes you're having to extend facilities, do what you got to do to get yourself into a position around an investment property, if that's part of your long-term planning. But you've got to understand why you're doing it. And for most people, they don't, you know what I mean? They haven't been given the context behind it and shown exactly why, okay, if you are going to do this, you're making a conscious decision around it, but here's the reasons as to why. It's just so many people that come into the school, or I've talked, for over 25 plus years of doing this, I've seen so many people where they refinance, are just chasing interest rates, are just chasing cash contributions, but they keep hitting the reset button and that loan term component, and they're in an awful position. They just someone contacted me the other day and said, oh, I started with I think it was a $260,000 loan, and I'm 18 years in, and I still owe about, I think it was 200 grand or something crazy like that on a 25-year term, because they were just, refinance, a top up, they do different things, and not really getting the context behind it. So it's important you understand if you're going to do it, know what you're doing, right? Really important too. But that's something. This is what I'm here for, right? So yeah, another reason is obviously to access equity, so you can do a cash out to refinance. So you can borrow against obviously your home equity for renovations. That's been coming up tonight. We've been talking about that, looking at further investments, whether that's into property or funds management, all sorts of different stuff you can kind of get into, or education as well, right? So that's where we see a lot of people doing stuff in that sort of space, using the debt equity in their home to release it via refinancing, but you're only doing that if you've got a plan behind it. That's my recommendation. Just not willy-nilly trying to set up refinances and cash out if you don't have something for it to go into reasonably quickly as well. Because what will most people do if they've got the money sitting around? You spend it, right? So we just want to avoid that type of stuff. So kind of timing is pretty crucial when you do refinancing as well. Now, cash contributions, okay? So in nearly every case, a bank will provide you with a cash contribution for switching lenders. So have I got my chat on? Let me have a look. In the chat, how many of you guys have received cash contributions when you've done your lending? Yeah, give me a little yes. Do you understand what I'm talking about? So when you've set it up, you've got a cash contribution from the bank. Yep, getting thumbs up. Absolutely. Cool. Rob and Jennifer, no. Right, well, we're going to school you guys. So for most of us, we would have experienced a situation where the bank has given us money to go to them, right? So some form of cash contribution to jump on board with them. So whether your original purchase, for a first home buyer, they dangle a cash contribution out there for you because they want to, well, it's kind of getting you to do business with them, but also it's really designed to help pay for some of the cost, right? So things like legal fees, stuff like that. And of course, if you were to change banks, there's often a cash contribution on the table for refinancing. However, there's cost involved with most of the banks too. So you might get a cash contribution. They might give you a percentage up to maybe about 1%, around that sort of level, for a refinance, depending on your loan size. But you've often got cost as well involved too, because you might have a new legal fee to set up your mortgage and so forth with the majority of the banks. But there's a couple of little tricks you can do, which I'll teach you in a second. But a cash contribution is there for you to choose what you do with it. Okay, so often you'll find with the cash contributions, there's a little bit of a we will give you some money, but type of clause, right? And that but clause is effectively we're going to have you sign something that says we're going to give you XYZ as a cash contribution, but if you pay it back within a certain period of time, typically like 3 years, you're going to pay that back. So some banks, it's the full cash contribution you pay back. Others have got a bit of a sliding scale down as you go. Okay, so you just got to be mindful of that. So if you're in a position at the moment where you've done your lending recently and you are thinking, oh, maybe we should change banks as an example, but you're in 3 years of that, you just have to factor in and go, well, right, we're going to have to pay back that cash contribution to the bank because they've already given it to us and we're still within that window of sort of time. So when you factor that in and potential costs of refinancing, sometimes for people they go, oh, that doesn't make sense, you wouldn't do it, right? So you've got to kind of get all the facts and costs behind you. But it is a little plus too though, because if you think of it this way, if you're in a position where you don't have to pay back a cash contribution because you're outside of that time frame, you're coming up to a position where you're rates are about to be renegotiated. And like I said, maybe you don't have the right revolving facility in place and you're thinking, oh, well, is this a good time to do it? Well, maybe it is a good time to do it where you go, what's that bank going to give me if I refinance, a cash contribution to sort of do this? And, interest rates you can kind of negotiate as well type thing. So, yep, absolutely. It does make sense if you're getting to that sort of stage. And sometimes not quite there, but getting closer. You put a little bit of a dangler out there just to sort of see what's going on in the market. And any decent advisor will be able to talk you through that just around, well, what does it look like from a cash contribution to help you with the numbers too? Okay. So that's important to understand. But and as I've already talked a bit about, is just the changing of the type of, loan facilities, right? So what type of loan we're going to go in from a variable rate. You might be sitting all on floating. It's a good opportunity to change banks because you have already come off your fixed rate, and for all the reasons I've sort of been talking about, is actually changing it. So you've got that fixed component and a bit of the revolving credit too. So a few reasons. Of course, debt consolidation comes into it as well, where you've got maybe some high interest debts like credit cards. So you might have car loan payments. You might have variable things there that you're getting charged a decent amount of interest on, that it might make sense to actually refinance that into the mortgage, as I talk about in the modules too. But one of those tricks to that often is just making sure that if you're going to refinance short-term debt, if it's I don't know, it's a personal loan that's got maybe a 5-year term, well, you don't necessarily want to go and refinance it in with your mortgage that might have a 25-year period and take that component over a 25-year period. Even though the interest rate is cheaper, it's going to be more expensive in the long term. So some of the structural stuff comes into play, which is most important. But the point is, this is what people do, right? They kind of go, let's actually tidy up all that short-term stuff. They use the equity in their place. So that's another reason why you potentially would look at refinancing. So I guess things to consider, right? A few here, just a few to go through with you quickly, is the refinancing cost. So there may be fees like break costs, application fees, and legal costs to actually do this. So as I said, your depends on where you are and who your conveyancer is and your lawyer and so forth. They might, I don't know, actually might take a little poll just quickly in the chat. Last time you guys did a refinance or a purchase, what was the average fee you paid? Any idea? Anyone remember? Was it sort of 1,500 bucks? Chuck in the chat for us. 1,500, 2 grand, 2.5. If you've got trusts and companies and a lot of complexity, it might be a bit more, but yeah, Tracy, 1,500. That's normally what I kind of recommend people allow for. But yeah, what's have we got any other takers on cost as far as that's concerned? Yep, Matthew, 3 grand. Yep, cool. 1,500 also, Carmen and Corey. Yep, cool. Yeah, so I mean, and look, there are other options where it's simple conveyancing and like it's one mortgage registration discharge type thing. Potentially you can get them a little bit cheaper, but like I think if you were to run some numbers, I normally would use about 1,500 bucks for a lawyer's fee. So you've got that, and like I said, there's potential break costs to get out of it. But what you've got to do is go timing wise. If you're coming up to obviously the end of your fixed term, you would just time your refinance to maybe happen at the time it comes off, so then you don't have break cost involved. However, some people will consider it early because you might only have a month or so to go. So it's like, okay, well, potentially there's a little bit of break cost we need to factor in. Same old thing. Get a quote from the bank. What does it look like to break that loan to get out of it? And then you just cost it into the overall package as far as, okay, I'm going to get this cash contribution. I'm going to go into this interest rate. What does this look like moving forward? So we just got to do the numbers as we go. So, some banks will charge application fees and so forth, but there are some lenders out there that will cover the refinancing costs, right? So, some of you might have experienced that with a couple of lenders in New Zealand where they'll actually cover the legal fees. So there's no legal fee involved, right? So it's a pretty simple refinance, not necessarily involving trusts. But if it's I don't know, just a couple on a mortgage document, they will pick that cost up. So you could get yourself in a position where there's no legal fees, but they're also going to give you a cash contribution, right? So where you've got to pay legal fees, obviously the cash contribution component is going to decrease a bit, of course. So it's not as attractive, but some of the lenders will do this, okay? And so that's important to understand as well, is obviously doing your research around that. So the main one we would use for that, I know that's going to come up as a question. That's Petty's put it in there. Typically, like that's a Kiwi Bank type scenario. They'll do that type of setup for most people if they're refinancing. There's no legal fee involved with it. Now, loan term impact. Obviously, we've kind of covered this off. The extending your loan term could mean paying more interest over time, which we don't recommend. So you just, we don't really want to do that. Break even point, we've got to calculate how long it will take the savings to outweigh the cost as well. So that's a simple equation to look at. If you've got a break cost, what does it look like on that rate to stay there for a couple of months versus if you break it now, jump on the new rate, how quickly you're going to claw it back, and then consider how much you're getting from a cash contribution and so forth. So sometimes, well, in a lot of cases, it does make sense to do it, but timing, once again, timing. So where you might not consider that is if you've got a position where potentially you're fixed in at a higher level at the moment. It may be 7%, and you're not coming off your fixed rate for another couple of years type thing. The break cost could be quite substantial to do that. So that's something where maybe you wouldn't do that, but once again, you just got to go through the numbers. Now, the other thing is, multiple inquiries or rejected applications could affect your credit ratings as well. So we just got to be careful. We want to make sure we do all of the work beforehand before you're sort of submitting applications, and just consider borrowing capacities. I mean, my team of advisors and stuff like that can help with this sort of stuff. But you would understand if we're making multiple applications, a potential, well, maybe you don't understand, potentially does actually affect your credit rating because you're making inquiries. So we just got to make sure we do that correctly as well. So when is refinancing beneficial? Well, current interest rate environment is one of these things where rates have started to come down. You're used to maybe having a higher interest rate that's than what's actually available at this sort of stage. Some of you might be going the other way. I know that for sure. You're coming off lower interest rates, and obviously you're going to be jumping up as well. So there's some stuff we have to consider around it. But obviously your financial position, situation, and goals, we've got to consider that sort of stuff, market conditions and property values. So as I was talking to Crit about before, a situation where obviously sometimes properties have dropped in value. It's about trying to make sure that they are still at a level that's you can get the right facilities in place as well. So doing your research around it is pretty important before you would pull the trigger on it. Some alternatives to refinancing. Okay, so restructure the existing mortgage and negotiate rate changes with the current lender. So that's right. That's something you could do. As obviously you don't necessarily have to change banks. It's an alternative too, as we know. Like we already talk about that. You can stay with your existing lender as long as you've got the right facilities in place. That's all good. So it doesn't mean that you've got to do it. That is an alternative, is just to stay put. But look, I'm going to just give you a couple of case studies of students that have actually done something about this recently, and having a look at a few numbers. Okay, so